2024, we know, ended with positive returns, about 8 to 9% on the headline indices, but about 23-24% for the mid and small caps. But the big question is, what's in store for us for 2025? Nimesh has done the most comprehensive market poll, and he joins in to give us the answers. Nimesh.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways. The highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the macro, the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. The other important factor was the rupee. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
We are going to speak to two veteran fund managers about what the year ahead holds for us. Let me welcome our guests for the day. Joining us are two market veterans, Sameer Arora, founder and fund manager at Helios Capital, and Sunil Singhania, founder of Abakkus Asset Manager. For starters, what is the philosophy a stock picker should assume? Bhagta hua ghoda ki piche, the one that's already performing for us, the EMSs, the e-commerce, the mid-caps, or do you go to the one that did not perform, the HDFC banks, ICICI banks, Reliances of the world?
So, I think the last 4-5 years have been pretty good, Latha, for all investors, and obviously the returns have been outsized, and obviously stocks which were like the obvious ones have not performed as well, but obviously the broader markets has done much better. 24 also is similar. If you actually see, Nifty has been more or less like 10-11% in terms of returns for the calendar year, though the broader markets have returned anywhere between 20 to 30%. I think going forward, it's going to be a little bit of a challenge. We're already seeing that, and as you rightly said, there is a lot of momentum in the so-called narrative themes, and maybe rightly so, because they have growth. However, as value conscious and more fundamental long-term driven investors, we are sticking to stocks where valuations at least have certain growth which you are able to build in, and valuations at any price obviously has not been our strategy. So it's going to be a challenging year ahead, though we remain optimistic. And I think as long as we as well as investors are happy with decent mid-teen kind of returns, I think we will follow our same strategy of focusing on fundamentals.
But it's going to be a challenging year, and making those 10-15% kind of returns, according to you, Sunil, is not going to be easy. So how would you construct your portfolio? What would be the advice? What would be the mistakes to avoid this time? And also, do you think earnings will make a comeback?
So on the second question, first, I'm very sure that earnings will come back. Obviously, December will be slightly better than September. But we do expect, the March quarter onwards earning to trend back to the double-digit growth. If that doesn't happen, then India does not qualify to be a growth market and will not obviously attract the kind of P multiples which it has been. But we are quite hopeful with the government spending coming back, monsoon's good, and the festive season as well as the wedding season in full swing. I think from now to June, which is pre-monsoon, activity should really pick up, and so would be the earnings. On your first question, actually, what typically happens is that obviously everyone likes momentum and everyone likes to be in stocks which are moving. And what has happened over the last, obviously, 6-12 months is that the segments which were mentioned, like EMS, to some extent, even the narrative sectors like defense, railways, after a big jump, they have sort of slowed down a little bit, but there is still interest. And there is this segment, I call it, the market cap from 101 to 250. I think that is the most overpriced segment of the market, and largely because mutual funds which are mid-caps have to compulsorily invest in that segment. And there are good stocks there, but if you see the valuation, nothing is below 60-70 PE there. So I think there is a sort of a issue of money coming in, and therefore funds having to buy the stock. And obviously when momentum is there and the price keeps on moving, the others are forced to invest in that. So I think it's going to be a tough time sort of resisting stocks which are moving up. At the same time, valuations at some point of time will start bearing on the stock price movements.
So since stocks where the market capitalization, if you rate it from highest to lowest, between 100 to 250, you're saying is highest, where we've seen maximum exuberance and valuations, etc. So would you bet with large caps and even small caps then?
So I think the good thing about India is that we have so many listed companies, and though our view is that IPOs are significantly overpriced, there are some decent companies which are also going to be listed over a period of time, which are already listed and going to be listed over a period of time. And as a portfolio manager, all you need is, maybe 5, 6, 7 good picks in a year, the new ones, and you are home. And I think with this large number of companies which are listed and the markets as well as the economic environment being so dynamic, from time to time one ends up, finding a few bets which you can look out for. So I think at this point of time, what we are trying to do is in our funds, which are like we have an all-cap fund, which is more a mix of large and mid. We have increased our weightage slightly to the large cap. On the other hand, we have a pure mid and small cap fund. There we are 100% mid and small cap. But I think what we're trying to do is shift towards companies where earnings are a little bit more visible and more sustainable in the near term also. So our experience over the last 6 months has been that when the markets have also been a little bit challenging, companies which have demonstrated resilience as far as earnings have ended up doing much better than otherwise. And I think little bit of more focus on near-term earnings is also what we are more concentrating on.
Sunil, Interesting you mentioned that IPOs made money, but you're saying that many were overvalued. Money Control did a study and 60% of the IPOs are actually even now making money for the investors. Of course, some of them are outstanding, like that Jyoti CNC, I think it was 300% or something above issue price. You don't think the IPO market is frothy, is it? You're saying that people are getting away with unreasonable valuation?
So I think right now the interest level is like crazy. And when interest levels are such crazy, you obviously will have in the near term, pricing also reflecting that. But, we are not here from a 3-6 months perspective, I think we have still not seen a major drawdown as far as the broader markets are concerned. The markets have been flattish last 6 months on the Nifty, but broader markets have been, I would say, pretty decent. I think once the valuations start to reflect the reality, that is when some of these companies, at least as stocks, would face a challenge. And the other thing is, Latha, what happens is when a company comes in for IPO, obviously there is a very limited history of performance in various cycles. And one is relying completely on the guidance given from a next 2-3 years perspective from the investment bankers and management. And no one gives negative guidance. Everyone's guidance is superb. So a company which has made 100 crores over the last 20 years cumulatively is expected to make a profit of 400 crores in the next 2 years. And you are willing to give the benefit of doubt till it comes. So I think let the result season start for these companies in the next 1 or 2 years. We'll know, how many of them end up doing better. But as I said, there are definitely good companies which are hitting the market. And there are companies which are maybe good, but overpriced. And then there's a third lot which are not good and overpriced. So, one has to be careful about the 3 buckets.
Yeah, absolutely. Sunil, tell us what could be the red flags that you would watch out for? I mean, not a worst case, but likely red flags.
So the good thing is that India still stands out. I am very sure that we will head back to the 6.5% growth rate. Obviously, Trump coming in will lead to a little bit of rhetorics. Obviously, he's known to speak a lot. But, every politician speaks a lot and not everything what they speak ultimately gets implemented. So once he takes power, who comes to power, we will see what happens. But we are already seeing some, movement on the currency side. Indian rupee has been resilient but still depreciated by 2.5-3% over the last couple of months. I think that movement has to be watched very carefully because depreciating money will push back maybe the likely FI inflows which we are expecting in 25. The other red flag is purely earnings. I think as long as corporate India keeps on reporting earnings which are 12 to 15% year-on-year growth, I think the macro are pretty decent. We are heading to the next 4 years, 5 years of this new government. Hopefully the budget will be pro-growth, which always happens in the first 2-3 years of a new term. We have decent foreign exchange reserves. I think there is a lot of government spending which is lined up. Companies are quite optimistic. And we are also coming out of maybe a 12-15 months of a lull as far as consumer spending is concerned, and that should also come back. So I think we are heading to a nice 2-3 year setup. I think the only thing we need is the corporate profit to come back, and that also hopefully from March will come back. From a global front, as I said, rhetorics and talks would maybe cause near-term ups and downs, but I don't see a major issue even there.
But doesn't it worry you that urban consumption has been falling? I mean, not just the warning from Godrej. Did you just see the Bajaj Auto sales also down, about 1.5% year-on-year? Will that not be an issue?
So, there are segments, obviously real estate. Everyone was selling apartments in Bombay at 1 lakh and 1,50,000 rupees a square feet. Now, there are only that many, Indians who would be able to afford those kind of apartments. And suddenly, you have buildings coming in left, right and center. Everyone is going in for redevelopment. And there is going to be a lull at some point of time, though we are quite optimistic about the real estate sales, but I don't think prices can go further from here. As far as auto is concerned, I think auto in India, two-wheelers and four-wheelers on the passenger side, has never seen volume growth consistently of more than 5-6% year-on-year. So I think it's not a surprise. And the other thing which you have not to forget is that the number of players are increasing. So maybe the volume overall is growing at 5-6%, but the listed guys are not able to retain their market share, which is happening in a lot of places. You know, I was speaking to a major tile company, and this is the segment is growing, but there are new players coming in from Morbi who are now selling in their own brands. So it is getting, you know, a little bit more competitive. And I think that is going to be the case. I think one thing which we should not forget, Latha, is that capital has been available in plenty, and hopefully that will be available in plenty. Now, capital raising is good for the companies, but we also have to not forget that it breeds competition. Because if a company is able to raise 1,000, 2,000 crores of capital, the ability of that company to compete with existing players increases quite meaningfully. And we are heading into a phase where maybe the ROEs, which was 17-18% for Indian corporates on a consistent basis, might fall to maybe more around 15-16%.
Thank you so much for joining us, Sunil. Well, with that, let's take our first break. We will take this discussion forward in a minute after this break with Samir Arora, founder and fund manager at Helios Capital.